when we talk about the devaluation of the dollar, generally speaking, money, when the dollar starts to go down in value, it has impact on a lot of other areas in different ways. If you're going to have an asset that's going to go down in value relative to other things around the world, people will want to own less dollars. And so what will they do with those dollars? They'll buy things. They might buy a house. They might buy a business. They might buy stock in a US company. So usually during a time period of devaluation of the dollar, what you might see is an inflation or an increase in the value of other assets as people want to own less dollars. They don't want to park a lot of money in their local bank account because they're fearful of the loss of spending power of that, and they're going to move that money to something else where they feel like it'll hold value. A couple things, that people tend to run to. Gold is an asset that people tend to run to when they feel the dollar is going down, because if you look at throughout history, over long time periods, gold has held its value relative to inflation. It's not a perfect tracking device, but it's a relatively good tracking device. Real estate is a good tracking device relative to inflation. Home prices over the course of long time periods tend to rise similar to whatever inflation averages in a society. And of course that makes sense. Why? Because at the end of the day, they can't rise significantly faster. Homes would just become completely unaffordable for the average citizen. And over time, home prices generally have a pretty steady rate on an affordability index. In other words, relative to how much money people make, homes tend to have a similar affordability over long periods of time to what people make in this country.